Good afternoon, everyone. I hope I'm audible to each and everyone present in this webinar. Our today's topic is China economic impact on SGX and KLSE. We have had several mails and queries of the client about this particular happening, which we have, seen in last 2 to 3 months since June. Not just China economic crisis we have seen in Greece, but that particular impact was not as much as we have seen China's economic impact in past 2 months. What we have noticed that clients are eager to know about what is this economic impact and how is it going to affect SGX and KLCI. We have seen such a sharp drop in both the index, and we have seen investors having risk averse uh, outlook for this crisis, and they are offloading or not ready to invest in these kind of circumstances. So we have our webinar today on China economic crisis, its impact on SGX and KLSE. Myself, Loveless Sharma from Epic Research, and we'll be going through this webinar. I would all request each and every listener to have pen and paper with them. If they have any queries or doubt, they can note it down. I'll try to answer that by the end of this webinar. Now, these are the contents that I'll be sharing with you. You can have a look at them, and we'll have resource trading strategies first to be discussed. Then global factors. What are the global factors which are currently in sight that are actually also being discounted by traders and investors around the globe? Then recent China's devaluation and the Asian exchanges. And then I have put some chart into this webinar to share as much as I can through charts so that it is easy to understand and interpret for all of you. Then I'll also discuss Shanghai Stock Exchange chart. I have taken a monthly and weekly view on it, so we can actually see what is the chart saying of the Shanghai Stock Exchange, and uh, how it is going to bottom out, what are the levels, and then I'll straightly take on to SGX and KLCI and discuss some charts with you as well, so we can actually see what are the markets going to bottom out, or where is the support, where is the resistance, and when there can be a turnaround. For example, last night we have seen crude oil sharply jump uh, like late hours of trading night, and as soon as the US markets open, we have seen US crude oil rebounding from multi-years low. So then I'll take the queries. So I'll start off this webinar. Well, Epic Research is an ISO 9001 2008 certified company and a leading financial services provider. We have our presence in global capital markets. We have offices and representatives in USA, Singapore, Australia, and other Middle East countries. We are headquartered in India. We provide stock recommendation and signals for SGX and KLSE. We also are having our division in Hong Kong and Shanghai stock exchanges. And we have a full-fledged research operation. We have a team of more than 30 analysts in the global team, and we have proven ourselves as an investment advisory company that produces and delivers high accuracy stock tips and recommendations for the Singapore as well as KLCI. We have a certain expertise in these markets: SGX equity, SGX derivatives, SGX Nifty, which we have traded on Singapore exchange, KLSE equity, KLSE derivatives. We are also providing signals in commodity derivatives like crude palm oil or index. We are also have some request of providing it in FGLD, global commodities market. We cover bullion, energy, and agri, and we also cover major currency pairs in global forex market. We have some trading strategies designed for mass investors. Now, these particular trading strategies are designed for our international investors who are trading in SGX and KLCI. For example, if you receive a signal which says above certain value, then you have to wait for execution or put a pending and stay in queue at the price as given. For example, we have given Biodenko Industrial 8176 code at above 0.430. Target would be 0.460, 0.490, 0.540. You almost have more than 100 cents of target here, and your stop loss is just of 50 cents. So first you need to understand that risk reward ratio is pretty much attractive here, what we are providing. The risk is of 50 cent, while the return, if you can see, is of 100 cent. Now these strategies actually try to churn out the best possible return for investors. If suppose you book some profit at first take profit, and then you actually revise your stop loss at the cost price or just above your cost price and book more profit on second take profit, which we gave our recommendation. In this particular case it is 490. Then you can actually trail your stop loss to first target and wait for third target. So in this case you actually are earning a $1 with a risk of 50 cents. So you need to understand that trailing stop loss is very important. In case if we are giving a buy call or a recommendation or a signal at CMP, that is current market price, you have to understand we are giving you a range to buy. For example, in this case, if we are giving buy Denko Industrial, you must understand we are also giving you a range of 0.430 to 0.440. I hope you understand that in this case you have a range to enter into this particular signal. In case you miss entry, immediately message your agent for the same. When you see that signal states, then you have to make an immediate entry and your action should be very fast. You receive 3 targets and you have to exit 60 to 70% on first take profit, 15 to 20% on second, and the rest of it on third take profit. This way you are actually maximizing your return in a single investment recommendation which may provide. If you book 60 to 70% on first take profit, you actually have profit plus your capital for second target, or can work for actually another recommendation which is given. So you need to understand that these strategies are specifically designed to optimize your result and churn out the best return on your portfolio. I hope this strategy is being followed by each and every one of you. If not, try to use it in intraday or positional, whatever kind of a trader you are, you must follow these strategies. Now, these are some mass strategies which we have for our international as well as national clients. Only buy above or below the level suggested or as recommended. Always keep proper stop loss in all your trades. Keep booking profits and trail the stop loss as advised. Do not trade in trials and only observe the calls. Never over trade. Do not trade in trials and only observe the call. Never over trade. Never trade on rumors. There are fundamental and technical factors that are working in the market. There are also economic factors that are being discounted in the market. But it is for sure that you shouldn't or avoid trading on rumors. Always consult our advisor or agent in case of any confusion or query. The better you communicate, the better we are able to answer you. We suggest to trade on all our calls and maintain uniformity in trading patterns. Do not change the trading capital lots in the middle of the month, as this will disturb your risk reward ratio. Those trading in single lot need to book profit in first target itself. So I hope this strategy you have seen. You can also visit our website epicresearch.co or .sg or .my to see this webinar later on. Now coming on to next slide, global factors. Now these are the global factors which are right now in sight. China's yuan devaluation that we have seen, United States Federal Reserve rate hike in September or December, given the amount of data they're having, downturn in Chinese economy, falling Asian exchanges and global markets, falling commodity prices, crude oil prices rebounds from multi-year lows, which happened in last two trading sessions that we have seen crude oil prices being rebound from multi-year low. Now, first and foremost is China's yuan devaluation. Why China has devaluated yuan? Now, there was a pressure coming onto the PBOC, People's Bank of China, that a lot need to be done on the currency side because the economy, which was growing at 14% few years back and has seen a continuous growth in last 2 decades, has suddenly shrunk and is down to 7%. The concerns of going below 7% is somewhat affecting the overall economic market. So China devaluated their currency against a basket of currencies and gave it more open space to be traded. Now, if you know that export of China was contracted by 8.8 to 9% year on year, and it was actually flat. So that's why there was a pressure on policymakers to devaluate its currency and let it be traded more freely so they can actually boost exports in their economy. But it does have its effect on the Asian exchanges that I'll try to explain later on. US Federal Reserve rate hike in sight. Now US Federal Reserve is also having its rate hike. Now that can be in September or December, but given the amount of data. But recent data that came in from US about tepid inflation, as inflation is very less over there, and Federal Reserve is actually wanting to have inflation to be a bit higher so they can have more space to hike the rate. Downturn in Chinese economy, recent fall to 7%, and going below 7% is one of the concerns. So this has actually created overall impact on the Asian exchanges like Singapore, Thailand, Malaysia, and other uh, Middle East economies will have effects on their exchanges, which we have seen. And we have seen global markets also falling, though they have rebounded in last week. We see Dow Jones and other European markets along with STE and SGX KLCI have some kind of rebounded and are taking some kind of consolidation in the recent week. Falling commodity prices is another concern because one of the biggest consumer of commodities is China itself. Then we have other Asian economies which are also focused, like if we have to take Malaysian economy is somewhat being very open to commodity like crude palm oil, and they have actually underperformed from last 1 year, especially if I talk about Malaysian ringgit. It has been seen worst year in last 1 year and it has actually depreciated. Crude oil prices have rebounded from multi-year low that can bring a relief to actually the Asian exchanges in the near term. Now this is one of the chart that I have tried to put over here. China's crash down and Asian exchanges. It's actually a timeline of how there has been certain events that back in 2005 China break the yuan peg from the dollar, and then US Treasury accuses IMF of being asleep at wheel. When China did this particular event in July 2000. Then there were certain events like China Development Bank issued first, dim sum bond, and somewhat current account surplus at 10% of GDP supports US claim yuan is 40% undervalued. Now it was actually kept 40% undervalued against basket of currency. At that point of time, China wouldn't was wanting their currency to be in the top five currencies which IMF recognizes, and somewhat being kept as in their holdings of sovereign holdings. But the recent happenings has been in since March when it widens yuan trading band to 2% from 1%. That what was somewhat given more space to be traded. Now these particular events, if you see what I was talking about, export actually shrank to 8.9%, and there was no actually improvement in the export side of the China. This was all actually putting pressure on the policy makers. And then we have seen a recent China devaluation so that it can be traded more freely. The exports can be improved, and the falling GDP growth can be boosted to above 9% in a 1 year time horizon. Now this is one of the charts I've tried to put on over here, China's crash down and Asian exchanges. Now if you see, these are the Asian exchanges I have to see. Now this is a percent change. If you see quarter till date, this is basically all the major Asian exchanges, KLCA, SCT, Sensex, and CSE, and other Asian exchanges. Now if you see actually this particular area year to date percent change, you'll see the sensitivity of this crash down to the economy. If you see TWI has been down 13.84%, while if you see Hang Seng is down 8% and somewhat 17% in this particular quarter. So this is actually sending, this is a short term trading scenario, but in the longer term, if you see 3 month, month till date, yearly or quarterly, everything is in red except two or three, like Japanese Nikkei or uh, TOPIX or Karachi. But if you see other exchanges like KOSPI, JKSE, SCT, Straits, KLCI, Hang Seng, and all other major exchanges, you'll see the deepness of this particular crisis from 25%, 24%, 17, 18. So we have seen a somewhat wipe out of all the investors' money that was in. Now the problem here was that people actually had invested in market somewhat by borrowed money or selling their assets and investing in the equity markets, and when the market crashed back in July and August, it actually wiped out more than 5 trillion itself in China's economy. So people were actually having cash crunch scenario over there. They had less check, now they have also borrowed money. Now they have to also pay interest on it. Plus they are not getting any investment return. If you can see, there is no particular return in quarterly. If you will see here, there is not a single return index which is giving a return. Or if I take Asian exchanges specifically, you'll see yield till date, all the profits have been wiped out and it is actually in negative territory. So people are right now being risk averse. They are not trying to invest in the market. Plus, they have a certain amount of debt or borrowed money they have taken from other people to invest in the market. So things have certainly changed. But I would also like to say that rather than investing in the market with a long term time horizon, you need to understand that every 7 to 8 years we see a market crash. Now, that can be from developed markets like US, or UK or European economies to Asian exchanges and other South and Middle East economies. You must understand after 2001 we have had crash in 2008, and this is somewhat again 7 years 8 years time horizon. So you need to understand it was actually bound to happen, but somewhat retail investors are being trapped in this, and they have seen capital erosion as well. So you must also keep a short term trading techniques which you can use, or short term trading uh, recommendations you can use to actually boost up the capital you have. Because investing long term, you need to understand when there is a deep correction, then only you have to invest long term in the market. But since we have seen emerging markets crash, you must understand you should focus basically on trading rather than investing for a long term. uh, these are some factors which I have put on here about the Asian exchanges. SGX and KLCI specifically had higher exposure of exports to China, and since the yuan has been depreciated, SGX Singapore had 10% of its exports exposure to China. Thailand, Malaysia have had exports of as much as 18 to 20% to China, with Japan having plus 20%. So you need to understand that worst impact was seen to Malaysia, which have had Malaysian ringgit underperforming for a fun complete year. The basic impact will be seen as in fall in exports and depreciated yuan to contract exports. Specifically, if I talk about Singapore and Malaysia, you'll see the fall in exports and margins of basically companies or particular sector which are in export specifically to China, and they have will have some kind of a depreciation in their earnings and margins. Then you need to have a fiscal consolidation. By fiscal consolidation, I mean there can be a currency war. Other economies may try to devaluate their currency in respect to other currency, because recent China devaluation are also sending jitters to Singapore, Malaysia, Thailand, and their economies. So you need to understand that it has actually given a currency war, but I don't see that in short term, because we are still awaiting the changes that China's devaluation will have on the economy like Singapore or Malaysia or Thailand, or Taiwan or Thailand. We have seen some kind of capital flight as well, and it can be from all these economy as well in the long term, but in the short term it is actually having impact on the market itself. This is one of the charts of ST which I would like to discuss, though it is just for information purpose, that where we can actually see uh, the Shanghai Stock Exchange bottoming out. This is a long-term monthly chart I've tried to, so that we can have a longer picture. Back in 2001, as I was saying, there was this crash which lasted for 3 years. If you see this downward movement, back like 2200, 2400, it came down to 1200. Then back from 2005 to 2008, it was gaining, and now it is down, came down in 2009. If you are a seasoned investor in the market, you can actually relate Shanghai Stock Exchange to crude oil, and you can see the chart. Since we have had crude oil going up to $140, then it came down to lower levels of $40, then it somewhat consolidated, and we have seen a breakout in STE back in 2014, and the markets went up to 5,200 itself. Now we are seeing some more kind of a correction, if you say overall, and this is actually a Fibonacci retracement of this particular fall from 5,800 900 levels to recent 1800 levels on the downside, 1600 levels on the downside, and then you can see it went up to 61.8%. Now it is correcting and we may see it bottoming out at these levels of 3000 because somewhat 23.6 will act as a support. Now I believe that we will see that particular bottoming out here and we may see marketing trading in range of 4000 to 3000 because it is actually one of the phenomenons that happens once in a year or once in a while after a long term of consolidation. If you see 70% has been consolidation, this is just 20% 30% of the trading. While see, if you can see here, from 2008 2009 early, there was a consolidation for 5 years and just in 1 year we have seen sovereign movement. Now this somewhat should end by September end or October mid, and you can see again a consolidation between 4000 to 3000 levels. This is a weekly chart. We have seen a gap over here. This was a triangle breakout on the downside, and markets from this particular rise from 2000 levels to 5000 levels on the upside, we have seen a crash to 3232 right now. The markets are finding support at 61.8%. A gap has been left in place, and the overall trading range will be now 3963, that is 38.2% to 61.83200, and the bottoming out of the prices will be at 3000. Though any bad news from the China's economy may send again, but everything has been discounted. But we need to understand that there are investors who are cash trapped and are awaiting some kind of up move so they can exit their position as well. Now this is the SGX weekly chart I've tried to put on FTS STI, and you can see I've tried to explain this weekly chart. I've tried not to the rise from 2002 when the China was consolidating or downward, we have seen up move. Then back in there was a systematic risk on the market. It went down. Now this is first move of the market. This is the second move. Now this was the third move. Right, we are expecting it to bottom out somewhere here itself because we have seen 38.2% has been a good support in the past. If you can see, 2800 levels have actually proven to be an uptrend. This is actually a breakdown from this particular, and we are actually in a neo wave, and somewhat it should have a consolidation between these level of 3100 to 2700 itself. The markets right now are itself in an oversold territory, and there can be a short-term pullback in the market. And this particular movement will put back market to somewhat at these levels. So a short-term correction cannot be ruled out. We have seen these kind of correction in the past like this, and this is one of the corrections that is happening on the monthly chart. So 38.2% should be acting as a support in the near term, and then we can see a bounce back to 3200 because this is a seven-legged pattern uh, correction which we have seen, and this would make a correction to this trend line which we have at 3200 3300 zone. This is a long-term chart, so in fact, if you see wave patterns over here, we can see this is one of the third waves and it is falling right now. It should somewhat end here, and we can see next leg of wave starting. This is a monthly chart for a long term view. Now this is KLCI. This is also a long term chart. It is actually in a channel. It is somewhat much better than SGX in making, and it is quite simple to be seen on chart. This is the first top in 2000. This is the second top, and we have seen third top falling. Now from here, if you see charts, this is the first bottom, this is second, and this may be third bottom. But you need to understand that we have seen a retracement of this particular rally to I think it was 50%, and there was another rally. Now, if you apply a Fibonacci extension to this particular fall, we'll be somewhat seeing this as a resistance, and 50% or 38.2% of this particular rally from 802 level to 1900 level. This must be second support of formation. If you see this and this, so the long term trend is still intact. A higher top higher bottom formation is on the chart. This is second higher top higher bottom. Now this will be a third higher top. We need to identify the bottoms in the next few coming trading sessions, as 1640 and 1500 will be some kind of a consolidation zone. If it finds a support, we may see a short term mild correction and then an up move. This particular up move can be till 1750, and somewhat a relief rally can be seen. We need to look at the numbers, not just China but also from Singapore and Malaysian market, and their currency and their exports and imports numbers. Contraction in the margin is somewhat important. The worst effect will be on actually the commodities, but recent rebound in commodity prices like copper and crude oil is seen as a positive sign. The falling prices of commodity and crude oil was somewhat saying the demand was less and the supply side was higher, but the recent rebound is giving somewhat positive hope, as the demand may pick up and we may see a positive rebound in these commodity prices, which will in turn help China to expand their economy, and it will send some positive signals to other Asian exchanges. Now, this is the SGX weekly chart. I'd like to share one thing over here as well. The third wave over here, if you see, this is a triangle formation and it has given somewhat a downward breakout. But you need to understand that when you are an overall bull market, you need to understand these Fibonacci retracements will actually play a crucial role and will have a strong consolidation, because we as an economy in Singapore, you must understand it is just 10% of your exports to the Chinese economy. While there can be a recent short-term correction, there can be a cash being pulled out from the market because Federal Reserve rate hike can be there, but it will be just a 0.25% base effect. You need to understand that overall economic conditions of Singapore are in a much better place than any other Asian exchanges or as compared to global markets, because we have seen a European crisis being built up. The US Federal Reserve is actually waiting for inflation signals to be there in the market, and then they will raise the interest rate. But there is not somewhat we have seen positive numbers on the inflation front, which is actually boosting the Federal Reserve to rate hike. So you need to understand this is actually somewhat a correction in the market which was overdue. If you see, RSI actually topped over here while the prices were making higher tops, higher bottoms. The RSI was actually topping over here and made a double top formation, and it has given a breakout. You need to understand it is actually near the oversold zone, and it is coming at 35. But coming at 35, when market was at 1500 level, we have seen RSI oversold to this territory, and in current condition, if you can see, it is already at 35. So any just down move will bring RSI to oversold territory, and we may see some kind of a value buying over here. People may jump in to invest in for the market for the long term horizon of say 5 years, and we can see some kind of accumulation also happening there, because we have seen somewhat a positive return in SGX as compared to other Asian exchanges and emerging markets. These are some of the research tools which we provide. At Epic, we believe in very transparent process. You can access all the regular updates and the call performance on our website. You can visit the same at our track sheets at www.epicresearch.my or .sg to access our track sheets, to see our reports which we provide on daily basis as well as weekly basis. I like to inform investors that in our reports we also provide recommendations on Singapore and Malaysian market. If you have our recommendation in our daily or weekly reports on SGX plus KLCI market, so you can access some kind of our recommendation in these reports. You can read them, also analyze the market and gain some insights. You can see them at www.epicresearch.sg reports.my reports. You can visit our website and services at epicresearch.sg and my, and you can call us in case you have any query or to be discussed at +6531581402 or +6035021947. Thank you for being such a good listener. If you have any queries, you can please ask. I'll be happy to answer you for next 5 to 10 minutes and have a discussion with you. We have one of the queries as what are the long-term impact to invest in the market right now, and should we able to have some portfolio built up in the near term. See, you need to understand that whenever there is a negative movement in the market, you need to understand that June and March, since March to August, you always see some kind of correction in the markets in each financial year. From since June or July to August or September has always been a kind of a correction period. I have also clearly stated each and every one of you that when you are trading in the market, every 7 to 8 years we will see a kind of a correction. 2001 we have seen correction. 2008 we have seen a correction, and this is 2015. Now this won't last for long. Why? Because I'll tell you a reason why it won't last for long. Uh, the major global markets like US and Euro are growing. We have seen a good number of data from global economic markets. The recent crash down in China will see some kind of consolidation in coming quarters. We have seen a market taking a bad experience since July, but I need to wait on this particular 3 months. I need to understand there are fundamentals are good basically of SGX and KLCI. So this is kind of a correction where you don't have to go for away from the market. You need to understand when market bottoms out, the rally which will have which will be contrary to the downturn, which will be upturn, will be very fast and dynamic in nature because people will try to jump in at lower levels. So since you are going to ask for long-term analysis of the market, you need to understand as soon as market uh, bottoms out in both SGX and KLSE, which I have discussed, like 3,200, 3,000 levels, while in KLCI as well. So you need to understand your long-term portfolio can be built up, not construction, but you can go for any counters or any scripts that are from pharmaceutical sector or fast moving consumer goods, and bankings are one of the sectors which will have a long term benefit. One of the questions is of shorting the KLSE. See, I would take you to the chart right in this website presentation. If you see a KLSE chart, you need to understand that we are actually in an overall bullish run. We have seen a higher top formation, and this one is one of. Now, I want you to know that shorting in such a scenario is quite naked or risky in character to the market, because you see this is first uptrend, this is second, this is third, and this can be a fourth. Now this is somewhat a wave pattern which we are forming. Now since we were in an overall uptrend, 23.6 we have seen, 38.2 has already given support to the market. You need to understand that as well, that there are trend lines which are in play over here. This is the first point, this is the second, and this is the third. So you need to understand, when in an overall bullish run you are at a lower levels, people will try to find out those lows and buy on every dip in the market. So these, for example, if you see over here, the formation of these candle as well, when we have seen in 2011, which we have seen like 3 months of continuous downfall in the market, we see bottoming out at the same level. In just 2 or 3 months, we actually gained, and we have seen this rally. So just previous question, as I have said, that people will try to jump in. So shorting KLSE would be quite risky over here. You need to understand, if you are shorting KLSE for intraday, our recommendations are there, that is all right. But if you are going to short it for a long term or a positional basis, you need to understand that there are supports and resistance that are in play. 38.2% has already given support, and I've shown you this particular trend line, which is also actually supporting the chart right now. And we may see some kind of a green candle formation in coming week or month, that can actually bring a relief to KLSE investors. So no, shorting right now is quite risky. Wait for the signals and do as per our signals. But if you want to go for a positional view, I would say avoid shorting right now. Thank you for being such a good listener. If you have any further more queries, you can answer or mail. I'll be happy to answer. You can mail at info@epiclearning.in. You can also answer at global@epicresearch.co. Thank you everyone for joining. We'll be having our next webinar on next Saturday, and we may be discussing some of the stocks which are lucrative to buy for short-term time horizon, or we can have a view on currency market as well. Thank you. Have a good day and happy weekend.